The Trump administration expanding. Tariffs on steel and aluminum imports on Monday. The move adds a 50% tariff rate on more than 400 goods with steel and aluminum components. It's going to mean higher canned food prices across the board for American consumers. In mid-August, the White House dropped another surprise. Tariffs on steel and aluminum did not just double from 25 to 50% earlier this summer. They now cover more than 400 additional goods that contain these metals. Importers had no grace period. Products already on ships heading toward U.S. ports were instantly more expensive the moment the policy took effect. The list is long and familiar. Wires and cables, car parts, home appliances, electronics, even soda, cans, items that millions of Americans use every single day. For consumers, it means higher bills. For companies, it means uncertainty because no one knows which category of goods might be targeted next. This sudden expansion shows how fast trade policy under President Trump can reshape the ground under households and industries alike. The impact is already visible in the numbers. According to the Producer Price Index released in late July, the price of domestic steel mill products was nearly 9% higher than a year earlier. Aluminum was up more than 13%. These are not abstract figures. They are costs that flow straight into the price tags of cars, refrigerators, and packaged food on grocery store shelves. Factories across the Midwest are feeling the strain. Primary aluminum is something that's always going to be imported into the United States, no matter what kind of tariffs you put on, whatever it is. Manufacturers that rely on imported aluminum face higher costs, and they point out that certain types are not produced in the United States, so the tariffs at expense without offering a local alternative. Smaller firms cannot absorb the increases the way global corporations can. As they scale back, entire communities lose the stable jobs that have sustained American families for decades. Instead of sparking a manufacturing boom, the tariffs are placing new pressure on the very towns they were meant to protect. Across the border, Canada has been moving in the opposite direction. We must reinforce our strength at home. That Canada will be introducing a series of countermeasures to protect Canadian steel and aluminum workers and producers. Ottawa responded quickly when Washington first raised tariffs earlier this year. By March, Canada had imposed its own 25% counter-tariffs on about 30 billion Canadian dollars worth of U.S. goods, covering steel, aluminum, and a wide range of consumer products. But Canada did not stop there. It introduced tariff rate quotas that limit how much foreign steel can enter the country and expanded procurement rules so that only Canadian firms or trusted partners can bid on government projects requiring steel and aluminum. The government also prepared financial support for major aluminum producers if U.S. tariffs remain in place, ensuring that companies like Riot Into can maintain operations and jobs. This approach has a clear goal. While tariffs raise costs, Canada is using the moment to strengthen its domestic industry, protect workers, and stabilize supply chains. Ottawa is signaling that it will not simply accept American pressure. It is defending its own market while keeping its industrial core intact. The contrast is striking. In the United States, tariffs were sold as a promise to bring jobs back and make industry stronger. Yet, the evidence so far points in the other direction. Higher steel and aluminum costs are feeding into inflation, squeezing companies and forcing layoffs at manufacturing firms that rely on imported metals. For American households, everyday purchases, from canned food to family cars, are becoming more expensive. Canada meanwhile, has acted quickly and decisively to protect its own producers. Rather than being cornered, it has turned the trade shock into an opportunity to reinforce its industry. The result is a tale of two strategies. One is creating turbulence for consumers and manufacturers at home. The other is building resilience in the face of pressure. This is the test of tariff. Politics push too far short term. Protection ends up hurting the very workers it promised to defend. Trump's trade policy now shows how protection can backfire, raising costs at home while unsettling global commerce. At some point, his view is maybe a tariff is better than a deal. Michigan's governor has directly raised the alarm with President Donald Trump after the damage his tariffs will do to the auto sector in America's car capital. In Michigan, the heart of America's auto industry, the pressure is building. Over the summer, President Donald Trump's latest tariff measures have landed with force, and the numbers tell a sobering story. General Motors reported its second quarter profits fell by $1 billion, attributing much of the decline to new import taxes. Stellantis said it lost $2.7 billion in the first half of 2025, also pointed tariffs as a major factor. Ford's latest results are expected soon, but analysts already anticipate the same pattern. Trump has pitched these tariffs as a way to bring manufacturing back to the United States. Yet in Detroit and across Michigan, the early impact is hard to miss. Rising costs squeeze margins and a growing unease that these measures may be hitting home harder than they are hitting foreign competitors. The new import taxes rolled out in the last several months could lead to more factory floor job losses, price hikes, and lower profits. The problem starts with the basics of production. Since June 2025, imported steel and aluminum, critical for vehicle frames, chassis, and countless components, have carried a 50% tariff. Canada, the largest aluminum supplier to the United States, is now facing a 35% rate on non-USMCA goods as of August. Mexico, though given a 90-day delay on new tariffs, still faces the threat of 50% duties on certain metals. And auto parts if talks fail. Outside North America, India's rate has been raised to 50%, affecting some automotive parts and materials that U.S. manufacturers rely on, even items far from the assembly line. Leather, textiles, and interior trim imported from Asia are caught in the net. The complexity of modern supply chains means that a car labeled Made in America can still depend on dozens of foreign-sourced elements, many U.S.-based. Suppliers themselves import critical subcomponents now taxed heavily before they ever reach a Michigan factory floor. So far, auto companies have been eating the impacts of the tariffs, and that's what we're seeing in the latest profit reports. It's only a matter of time until the companies pass those costs off onto the customer. At first, the big three absorb these new costs, hoping to protect sales. But according to the Center for Automotive Research, the 25% tariffs on autos and parts alone could add $18 billion to industry costs in 2025. That figure doesn't even account for the knock-on effects from 50% steel and aluminum duties or the layered tariffs from multiple trading partners. The Alliance for Automotive Innovation warns that these costs will inevitably reach consumers. Higher sticker prices could push entry-level models off the market entirely, reducing choice and slowing the rollout of new technologies. Electric vehicle makers face an extra hurdle. The U.S. still lacks a large-scale domestic battery manufacturer, forcing reliance on imports that now carry steep tariffs. In Detroit, cutting production means more than fewer cars on the lot. It means fewer jobs, especially in Communities that have spent decades rebuilding after past downturns. Analysts say the next 3 years could bring sustained declines in sales and employment if current policies stay in place. Trump sees tariffs as leverage to pressure trading partners into investing in the U.S. and opening their markets. Canada's Prime Minister Mark Carney, however, has stayed firm, keeping most Canadian exports tariff-free under USMCA and seeking new trade routes abroad. He maintains that the steep duties on Canadian metals and parts ultimately raise costs for U.S. consumers and manufacturers more than for Canada. It's a test of two strategies: Trump's high pressure push for quick concessions versus Carney's long-term approach built on stability and alliances for America's auto sector. The outcome will shape whether these policies deliver stronger domestic production or deepen the cost and job losses already taking hold in Michigan and beyond. This guy's coming at us. I just want to go on record. He's coming full bore at us. We got to move quicker. And folks, be ready. He's not waiting till 2026. At any given time, President Trump, he could pull the carpet out from underneath us on Kuzma tomorrow with one signature. Ontario Premier Doug Ford didn't mince words in a press conference that cut through political nuance. He warned that President Trump could end the COSMA trade agreement not in 2026, as expected, but as early as November 2025, and he may not even follow a formal process. All it could take is one signature. For called on Canadians to brace themselves. This wasn't a normal trade dispute, he said. It's something far more volatile, coming from a provincial leader with strong ties to business and conservative circles. The message landed with weight. The concern is not hypothetical. Ford isn't just worried about tariffs. He's worried about COSMA itself, the legal backbone of North American trade. Almost every country in the world that's trying to negotiate with this administration, it's very challenging. You think you're getting close to a deal, and then the cheese slips off the cracker when it gets to the president's desk. So, look, I think Ford's right. That concern is echoed at the national level. Conservative strategist Corey Taney said it plainly. The worst may still be ahead. Trump's approach isn't rooted in conventional trade norms. He's abandoned negotiation frameworks, rejected predictability, and applied pressure without offering a path to resolution. The 35% tariffs imposed on Canada under the IEPA are just one example. The deal-making process now moves according to Trump's timeline and his mood. It's not just Ford who's lost trust. There's growing doubt across Canada's leadership that any deal with this U.S. administration can be relied on. After all, Trump is threatening to override agreements he once championed. CUSMA itself was signed under his presidency. Canada and Mexico themselves have about $50 billion in two-way trade. So that's nothing to sneeze at. It's highly unpredictable. And so both sides need to sort of get together and figure out what the hell's going on, while Trump escalates. Canada and Mexico are recalibrating. This week, Canada's foreign affairs and finance ministers traveled to Mexico for high-level talks. The agenda wasn't ceremonial, it was strategic. Trade officials and business leaders from both countries sat down to align supply chain goals, discuss trade, infrastructure, and build a united response to what one expert called both Canada and Mexico are being hit with emergency tariffs, though Mexico was granted a 90-day pause. Yet, the message is clear. Neither country trusts the current state of U.S. trade policy. In place of that trust, they're forming their own foundation, one grounded in mutual reliability not coercion. But building that foundation takes time. And time is exactly what the markets may not have. On July 31st, the U.S. Court of Appeals reviewed the legality of Trump's emergency tariffs. Lower courts had ruled against them, but let them proceed, citing ongoing talks with China. If courts strike them down, Canada might be better off waiting than rushing into a bad deal. Ottawa now faces a dilemma: take a risky agreement or wait for legal clarity that may never come. We can either wring our hands and lament the fact that the U.S. administration is doing this, or we can get to work on building our own economy by getting started on projects that, frankly, should have been done 20 years ago. Inside Canada, the message is starting to sink in. Yes, provinces have different priorities. Alberta wants to protect oil, Ontario its auto and steel industries, and Quebec its aluminum. But Ford noted that 98% of what's needed is shared. The divisions are shrinking. The urgency is growing. Large-scale national infrastructure projects, long stalled, are being revisited as a way to build internal economic strength and reduce dependence on unpredictable trade flows. It's not just about defending sectors anymore. It's about defending sovereignty. Trump couldn't force Canada to fold with tariffs, and now facing a firm but calm Canadian government, he may try something else, dismantling the agreement entirely. Ford's warning was blunt because the stakes are real. Without Kuzma, decades of trade predictability could vanish overnight. Canada and Mexico are no longer reacting. They're preparing, because when trade becomes a power game, stability becomes strategy. And in this game, survival may depend not on what Trump does next, but on how Canada and Mexico respond together. The fourth largest producer of oil and gas in the world, Canada exports 97% of its resource to the U.S. 60% of oil and gas that goes into the United States comes from Canada. Donald Trump says he wants to protect American energy, but what if he's quietly weakening the very foundation of it at a time when energy security is more important than ever? The U.S. still relies heavily on imported oil, and most of that oil, about 2/3, comes from one place, Canada. Yet Trump's own trade policies are threatening to disrupt that flow. How did we get here? Where the United States needs Canadian oil more than ever, but Trump's strategy is pushing it away. It seems not very exposed because it's the one thing the U.S. hasn't really put any tariffs on so far. I think they recognize they need our oil and gas to provide energy security for their country, and that if they tried to put a tariff on it, they'd still have to buy it. It would just mean higher consumer prices. Canada supplies between 50% and 70% of all U.S. oil imports, averaging around 4 million barrels per day, according to the U.S. Energy Information Administration. This isn't just about volume. Canadian crude is uniquely suited for American refineries, especially those in the